As expected, the monthly CPI indicator rose 5.2% in the 12 months to August. That's an increase from the 4.9% in the 12 months to July that we saw in the previous reading. Now, the most significant price increases were for housing, as was the case in the last reading, and transport. Food and non-alcoholic beverages were also a large contributor, as were insurance and financial services. Now, it's not unexpected that we were seeing an increase. That was the forecast. The July reading at 4.9% was a little lower because of the way the monthly numbers are calculated, and economists did point to the fact that because of the calculation and what's taken into account in the July month, that there was likely to be a pickup in this month. In saying that, we are still well off the peak of 8.4%, which was recorded for the month of December last year on an annual basis. So the 12 interest rate increases that we've seen from the RBA since May last year are certainly working to cool inflation. And of course, we have an RBA meeting next month, so whether or not this 5.2% is enough to keep them on hold remains to be seen. But the market is only anticipating a 10% chance of a rate rise next week, which would take the cash rate to 4.3%. But look, this is broadly in line with what the RBA is expecting in terms of where the inflation rate is at the moment. And when it comes to the main contributors, we saw a big jump in rents, and that is continuing. Everyone, we know we've been speaking about rental increases for quite a long time. And of course, international travel was a big contributor last month. The ABS says that inflation has often been impacted by volatile items like fuel, fruit and vegetables, and holiday travel. So when you exclude these and the underlying inflation rate, the annual rise is 5.5% in August, which is lower than the underlying rate that we saw in July of 5.8%. So we're still seeing a higher underlying inflation rate, excluding those volatile items. But the fact that it's come down in August from July is a real positive, because that was not so much the case in the previous read. But Karina, I will bring in Sean Langcake, the macro strategist at BIS Oxford Economics. Sean Langcake, I've done a lot of talking, but you have been looking at the numbers as well. What were the biggest drivers today in terms of that inflation increase?
Yeah, I think if we're talking about the headline numbers, certainly a bit of a boost there from fuel prices. We know that these have been drifting higher through August, and they've continued into September, unfortunately. So a bit of a boost there. But as you're right to point out, a bit of a downward trend in the underlying series, which is encouraging. Certainly, these numbers still are relatively noisy. They're certainly not viewed as the main game by the RBA. They'll wait for the quarterly print to put a bit more weight on that, but some signs of improvement there, as you say, as they come down from the peak.
Yeah, and that transport component up 7.4% in the month. Housing has also been a big contributor to inflation generally. Housing was up 6.6% in the month on an annual basis in August. What are we seeing in terms of housing driving up inflation? How's it working? Is it mainly rents?
Rents are certainly on the way up, and you don't really have to look too hard to find evidence of that. A lot of pressure in rental markets. The vacancy rate is historically low, and demand is really strong. So, certainly that cycle has further to play out, and unfortunately, that's likely to remain an upward pressure on inflation. The other major part of that component is the cost of building a new dwelling. We know that this absolutely surged out the back of the pandemic. It's coming off its peak, so a little bit of relief in that grouping there. Equally, there's a lot of relief from the government on utilities bills that is playing through as well, which is helping keep a bit of a lid on inflation in the housing component. So, yeah, a really mixed bag, but still rents are set to drive that component through the next year or so.
And you said the monthly inflation data is not the main game for the RBA. The quarterly inflation number for the third quarter will come out at the end of October. Does that mean the RBA is going to hold off on raising rates until we get that number? or making a really strong decision on rates until we get that number.
Yeah, I think that's the case. Certainly inflation is still very high. It's uncomfortably high, and it's well above the RBA's target range. But we've seen them pause for the last 3 months, and certainly, there's nothing in these numbers that make the case for a rate rise more compelling than it has been over the last few months. They're clearly on a trajectory where they're happy to kind of let the interest rate hikes to date play through. They still have more work to do to cool demand, and they will over the coming months. And yeah, I think I see the RBA on the sidelines until well into 2024 at this stage as they kind of let things run their course.
And as I mentioned to Karina, there's around a 10.8% chance priced in by financial markets that we would see a rate hike next week by the RBA on the first Tuesday of October. But there's real concerns about higher interest rates for longer in the US. Is there a risk here that perhaps interest rates won't come down as fast as people have been expecting?
Yeah, certainly. I think that's the case. I mean, I think, any talk of rate cuts, well, certainly in 2023 or even early 2024 is quite premature. There is still, we've had a very big disinflation as supply chains normalize and, goods prices kind of come off. But, if we look at the services components of inflation, that's still on a bit of an upswing. And, there's decent wage growth coming through, which all pushes that up. So, we're certainly not in a world where it's absolutely guaranteed that inflation comes back down into the target range in a smooth fashion. It could take a while. And indeed, the RBA don't see that playing out until well into 2025. And, while inflation remains above the target range, I don't see them cutting interest rates. So, yeah, we're certainly, we've moved into restrictive territory with rates, and I see them sitting there for, at least 12 months, possibly longer.
Okay, so a very quick one. What's your peak rates forecast?
Look, I think we're there. Like I say, I think the case for another rate hike is not going to be more compelling than it was a couple of months ago. And the RBA is now prepared to be patient. There's always a chance that we get a nasty upside surprise in the Q3 data, and the main source of that's likely to be unit labor costs. But I think there's enough kind of wiggle room for the RBA here, certainly in their forecast for them to ride it out from here.
Sean Langkate, great to get your insights. Thank you.
Thanks for having me.